right, let's talk a little bit about risk and return. So anytime you're doing some sort of investing, there is risk involved. Some things are more risky, some things are less risky. So let's just kind of quickly go through some of those examples here. And basically on this handout, I've kind of just copied in a couple pages from your text because there's just so much information there. It really wasn't worth just typing everything over. So I'm going to quickly read through it with you guys, but I encourage you to go back through it again and read through it one more time. So when you deposit money into a bank account, you're making a cash investment. Because bank accounts are insured by the federal government up to about $250,000, there's no risk of losing the principal you've invested. The account's interest rate guarantees a certain percent increase in your investment called its return. So when you just have a regular savings account, again, up to a certain limit, you don't have to risk losing any money. So you know it's there for you to use, you're not going to lose any money on it. It's guaranteed by the US government. So that's different. So that's, your safe bet, and it's when you want to have money that you can easily access to. All investments involve a trade-off between risk and return. So different types of bank accounts carry little or no risk. So investors must be willing to accept low returns, right? So if there's low risk, you're not going to get a high return. Right now, savings accounts, at least most of them, are very, very, very small percent of return. So your rates are very small, like 0.5% even, or maybe just a small amount of a percent. Other kinds of investments are riskier, meaning that it's possible to lose all or part of your principal. These are usually called stocks and bonds, but they tend to give higher returns. So when you're willing to invest in something like a stock, you run the risk that you will lose your money, right? So you could actually lose some of your investment. However, there's also a chance that you can make lots of money too. So things that are riskier have more chance of making a lot of money, but they also have a chance of losing a lot of money too. Whereas things that are less risky have a less chance of making a lot of money, but also a less chance of losing money. So, there's a balance between the two. So what is a stock? Investors purchase stock, which are shares of ownership in a company. So when you own stock, you actually own part of that company. So a stock is a share of ownership in the company. The share indicates the percent of ownership. For example, let's say a company has issued a total of 1 million shares, and as an investor, you own 20,000 of those shares. Then when you divide those together, you get 0.02, which is 2% of the company, right? Multiplying that value by 100. Any investor who owns some percentage of the company is called a shareholder. So if you own stocks, you are a shareholder. Buying or selling stock is referred to as trading, and shares of stock need both a seller and a buyer to be traded. They are traded on the stock exchange, and the price of that share of stock is determined by the law of supply and demand. So if a company is prospering, investors will be willing to pay a good price for the stock. The stock price will go up. If the company is not doing well, investors may decide to sell and the stock price goes down. So stock prices indicate the performance of the companies they represent, as well as the state of national and global economies. So basically, if a company is doing well, the price of their stock increases, right? It costs more to own a piece of the stock. If they're not doing as well, the price tends to decrease. You always need a buyer and a seller for each piece of stock. And that's something I always warn people about is, let's say they have money in the stock market and they say, oh, but I have $5,000 in the stock market. I can see that I have $5,000, which is true, but you need somebody to buy that, right? So it goes both ways. Theoretically, your stock is worth $5,000, but if you can't find a seller, then it's not worth $5,000, right? So it can fluctuate even from day to day how much stocks are worth. They change throughout the day. So it can be quite volatile how fast they can increase and decrease in price. When you sell your stocks for more money than you paid, it's called a capital gain. So you gain money. When they can also be capital loss if you sell stocks for less than what you paid or if the company goes bankrupt. While you own the stock, the company distributes all or part of its profits to its shareholders as dividends. So each share is paid the same dividend, so the amount you receive depends on the number of shares owned. Some companies reinvest all profits and do not distribute dividends. So dividends are parts of the profits that the shareholders typically receive, but not all stocks pay dividends, okay? So a dividend is like extra money that you would get as part of the profit if the company is doing well. When more and more average Americans began investing and making money in stocks in the 1990s, the federal government cut the capital gains tax rate. So long-term capital gains, which are profits on items held for more than a year being sold, and dividends are taxed at lower rates than wages and interest earnings. Okay, so if you're selling stocks and things like that, you're still paying taxes, but not at the same rate. Now, there is something else called bonds, which is another kind of investment opportunity. And people who buy stock become part owners in a company, and but bonds is different. So in order to raise money and not dilute the ownership of current stockholders, companies will sell bonds. So people who buy bonds are lending money to the company from which they buy the bond. So a bond is like a loan. It's not an ownership in a company. So when you buy a stock, you own a piece of that company. When you purchase a bond, you're loaning money to that company. So it's like a loan. Bonds are a commitment from a company to pay the price an investor pays for the bond at the time it was purchased, called the face value, along with interest. There are many reasons for issuing bonds. So a company might need to raise money for research on a drug that has potential for curing AIDS. So maybe it issues bonds. The U.S. Treasury Department issues 30-year bonds at a fixed 7% annual rate to borrow money to cover federal deficits. And local governments often issue bonds to borrow money to build schools, parks, and libraries. And again, just keep in mind that any of these numbers are based on the year of print. So, rates could change over time. Bonds are also traded like stock, and their price is a function of supply and demand. So if a company goes bankrupt, bondholders are the first to claim the company's assets. They make their claims before stockholders, even though they do not own a share of the company. So because of this, investing in bonds is less risky. So with a bond, you're going to get a lower percent rate return, but you have a better chance of getting your money back, because if the company goes bankrupt, any money left over pays off the bonds first, pays the loans first before it pays any shareholders. So you're like first in the line to get paid if the company goes bankrupt. It's not 100%, because if there's no money, there could be no money at all. But if there are any assets left, then the bonds get paid first. All right, so a mutual fund is like a combination of them. So it's not an easy job to determine which stocks and bonds to buy or sell, or when to do so. IRAs can be funded, even IRAs can be funded by mixing stocks and bonds. So many small investors have decided that they do not have the time to stay informed about the progress of corporations, even with the help of online industry research. So what they do is they invest in a mutual fund. And a mutual fund is a group of stocks and or bonds managed by a professional investor. So instead of buying individual stocks or individual bonds, a person can buy part of a mutual fund, which is really a larger group of a whole bunch of stocks and or bonds thrown together that a professional is managing. So they're doing all the buying or selling, and you're just buying that mutual fund, so that you're not the one worrying about all the stocks and the bonds in the background. So a mutual fund is a group of stocks or bonds managed by a professional investor. And when you purchase shares in a mutual fund, you give your money to the fund manager. So your money is combined with the money of other investors in the mutual fund. And the fund manager invests this pool of money, buying and selling shares of stocks and bonds to obtain the maximum possible return. So you're basically putting your money in the hands of somebody else to do all the trading for you and decide when it's right to buy different stocks or different bonds, but you still are investing in that particular mutual fund. Even though the stocks and the bonds can be changing, you're still part of that investment. Investors in mutual funds own a small portion of many different companies, so they have lots of different stocks potentially, which may protect them against poor performance of a single company. And when comparing mutual funds, consider both the fees charged for investing and how well the fund manager is doing with the fund's money. Newspapers publish ratings from 1 meaning worst to 5 meaning best of mutual fund performance based on whether the manager is doing a good job with its investors' money. 2 numbers are given. The first number compares the performance of the mutual fund to a large group of similar funds, and the second number compares the performance to funds that are nearly identical. So the best rating a fund manager can receive is 5 out of 5, and the worst rating is 1 out of 1. A listing of all investments that a person holds is called a financial portfolio. And most financial advisors recommend a portfolio with a mixture of low risk and high risk investments. This is called a diversified portfolio. So basically, it's recommended that you don't just put all your money into one thing, right? Which makes sense because if that one thing doesn't do well, then you've lost all your money. So what most people recommend is that you put your money in lots of different things. So you do some different stocks, do some different bonds, some that have high risk, some that have low risk, so that you're kind of balancing out your risk a little bit. So you don't have all your eggs in one basket, so to say, right? You're kind of putting them all in different baskets so that if one account does bad, hopefully another one will do well, and it balances out that risk for you. So that's what's called diversifying. And so your three main things tend to be your stocks when you're buying an actual part of the company, a bond, which is really like a loan, and then a mutual fund, which is a fund that contains a bunch of either stocks and or bonds all put together. So you're buying a piece of that, and your money is getting lumped in with other people's money to invest in different stocks and bonds. Okay, and that's an easy way to diversify so that you don't have to worry as much about it, but you want to make sure you pick a fund that is doing well so that the person who is managing it, who is a professional in the field, actually knows what they're doing. All right, reading stock tables. Again, I know it's a little bit blurry, so again, read it through your text as well. But your daily newspapers and online services will give you stock information. So we're using an example here. This is for FedEx, Federal Express, to learn how to read the daily stock tables. And you can find these in newspapers and online and so on. All right. So the first value here is the 52-week high. This is the highest price at which FedEx sold during the past 52 weeks. So from that point, not necessarily like January to December, but whatever the last 52 weeks was, that would be the highest price it sold for. And then the 52-week low is the same idea, but it's the lowest price it sold for in the past 52 weeks. So in the past year, what was the highest and lowest price that that stock sold for? So someone paid $99.46, someone else paid $34.02, and all the values in between could have been bought and sold too. The stock is the name, right? So the heading stock is the company name. This one is FedEx. The heading SYM, think of it as symbol, right? Is symbol the company uses for trading. So it's really like an abbreviation. So instead of writing the full name out, they'll write FDX, which represents FedEx. Okay, so it's just a symbol for the company. All right. The heading DIV, which is right here, refers to dividends. So not all stocks pay dividends, but if they do, it's listed here. And that's the amount paid per share to stockholders during the past year. So FedEx paid a dividend of 44 cents per share. So let's say you owned 100 shares. Then you multiply that by the 44 cents, and you would have been paid $44 in dividends in the last year. So that amount gets multiplied by however many shares you have, and that's kind of like a bonus on top of what you make for selling stocks. So that's a piece of the profit. All right, the next one, the year-to-date heading, or the yield percent, excuse me, wrong one. The yield percent stands for percent yield. It's hard to see here, YLD, it's a little blurry. In this case, the percent yield is 1 or 1%. The stock table does not show a percent sign, so even though it's not there, this is a percent. So that's in percent form, not decimal form. This means that the dividends alone gave investors an annual return of 1%. So this is the annual return from the dividends. So this is much lower than the average inflation rate. However, this percent does not take into account the fact that FedEx stock prices might rise. So an investor sells shares for more than purchase price, then the gain might make FedEx a better investment opportunity than just a regular bank account. So the yield percent is the return on the investment based on the dividends only, not if you were to buy or sell shares. All right, let's see what's next. In order to understand the meaning of PE, we'll need to understand some of the other numbers in the table first, so we'll come back to that one. So the next one is VOL 1000, which stands for sales volume, 100, sales volume in hundreds. So this is the number of shares traded yesterday in hundreds, okay? So number of shares traded yesterday in hundreds. So add 2 zeros onto that number, and that gives you how many shares were actually traded. So HI stands for the highest price at which FedEx was traded yesterday. So again, this is all yesterday stuff. So FedEx traded at a high of $45 yesterday and at a low of $43.47 yesterday. So these are the amounts for yesterday. Okay, so LO stands for the lowest price for yesterday's trade. The heading close stands for the price at which the shares last traded when the stock exchange closed yesterday. Okay, so at the end of the day yesterday, the stock exchange closed, and that's the final price it traded for that day, $44.08. Okay, so that's called the closing price. And then finally, the net change, NETCHG stands for net change, sorry. This is the change in price from the market close 2 days ago to yesterday. So it's how it changed from 2 days before to yesterday. The number negative 1.60 here represents that the price of a share of FedEx stock went down by $1.60. For some stock listings, the notation appears under net change. This means that there was, if you see ... it means that there was no change in price for a share of stock from 2 days ago to yesterday. Okay, so this is the net change from 2 days before to yesterday. So here, if it's negative, it means the price went down overall. All right, so finally, going back to that label of PE up there. So we're down here now in the reading. Now we are ready to return to the heading for PE, which stands for price to earnings ratio. So P for price, E for earnings. And it's a calculation. So what you do is you take yesterday's closing price and you divide it by the annual earnings per share. Now we can also reverse the order if you want to have the annual earnings per share equals yesterday's closing price divided by the PE ratio. So the PE ratio for FedEx was 19. You can see that up here in the table, right? 19. And yesterday's closing price was $44.08, which again, you can see up here, $44.08. There's the 19 in the table. So if I want to calculate the annual earnings per share, I can take that $44.08 and divide by 19, and I get 2.32. So the annual earnings per share for FedEx were $2.32. The PE ratio 19 tells us that yesterday's closing price per share, the $44.08, is 19 times greater than the earnings per share. So it gives us the ratio of your closing price and the earnings per share. Okay. So that's just some information on how to read those stock tables.